The number one industry lie about annuities is that there is a reasonable possibility that you might run out of money if you invest in the open stock and bond markets, and therefore you should give up, throw in the towel, lock your money up in an annuity prison, and accept higher taxes and lower returns in exchange for some guarantee that the insurance company offers. But are these guarantees really necessary? Is investing in an age-appropriate portfolio of 75% bonds and 25% stocks really that risky? The fear that investors have is that we might head into another recession, and then your savings is going to suffer and lose value. Then one day, at the age of 80 or 90, you're going to be forced to go to work at McDonald's, even though you were doing the right thing by only taking out the recommended 3 or 4% per year out of your savings. And by the way, notice that I said stock and bond markets. Now, there's lots of dishonest advisors out there who love to tell you stories about senior citizens who had to go to work at McDonald's after the stock market declined from 2000 to 2009. What they cleverly aren't telling you is that the reason these senior citizens got themselves into this situation is because they committed the cardinal sin of taking on too much risk. They were way over allocated into stocks. It wasn't the stock market's fault. It was their fault for failing to diversify into bonds. Now, one of the pillars of investing is painfully simple. Never bear too much risk or bear too little risk. If you bear too much risk, for example, by investing 100% in the stock asset class with no bonds, one day, if stocks drop, for example, 50%, they have to come back a whole 100% just to get back to even. And that's why for retirees, diversification is critical. Bonds are slow and consistent, and there's an old adage that says when stocks fall, money runs to the safety of bonds. So if you're in retirement or approaching retirement and you're not mega wealthy, don't bear too much risk. Don't put all or a whole bunch of your money in stocks. Now, on the flip side, they say never bear too little risk. For example, right now, if you were to put money in a bank CD, you're basically not investing at all. Your principal is going to gradually erode if you are spending down that money in retirement. Inflation is also nibbling away at the spending power of that money, perhaps 3% per year. And finally, we have annuities, which at least pay more than CDs, but consistently don't perform as well as low-risk bond stock portfolios. Now, again, the narrative you get from Mr. High Commission-based advisor who is trying to sell you that annuity is that the bond stock market is risky. And he'll talk about the stock market decline from 2000 to 2009, but is he really being truthful? And of course, the answer is no. And if you watch two of my other videos, I showed you this chart. And as you can see, there was no crazy volatility. It doesn't exist. In fact, from 2000 to 2013, there was only 1 year when the 75-25 portfolio of two ETFs would have lost money, and that was only about 3%. And in every single other year, the 75-25 portfolio gained value, whereas this insurance company's best performing index annuity gained nothing for 4 of those 13 years. So the reality is that the annuity was the failure, because with the annuity, you are predictably shortchanging yourself by being a coward and bearing too little risk. And if you want to go back further in time to 1980, there was only 1 year in that 20-year period lasting until 1999 in which the 75-25 portfolio lost money. But the most important point is that in times of recession, this fear of loss of principal is nonsense. It's hysteria. Okay, so now what about during times of depression? If we went back to the 1929 stock market crash, which preceded the Great Depression, Now, first of all, there's plenty of experts who will tell you that a drop of 90% is completely unrealistic because the stock market today is not what it used to be. For example, there's too much 401k money, pension plan money that's not going anywhere. There's money managers whose job it is to invest, not to sit in cash. So those forces of demand are going to prevent a really catastrophic collapse. Also, since 1929, many measures have been put in place to prevent stock market overvaluation and to prevent panic selling. For example, before 1929, there was no Securities and Exchange Commission, there was no FDIC, there was no Glass-Steagall Act, no quantitative easing. I could go on, but instead I have posted a link in the description below this video. But just for fun, let's see what would have happened to $100,000 invested in a 75-25 portfolio at the worst possible time, right before the 1929 market crash. And as you can see, it never dropped lower than 14.5%, which was in 1931. And when you account for the deflation that was occurring back then, in reality, you weren't down 14.5%. You were actually about even because the purchasing power of people's money was getting greater and greater. Goods and services were getting cheaper. So you ask yourself, how was this possible? Number one, deflation. Number two, stocks were paying huge dividend yields back then. In fact, at the time the stock market hit its all-time low, the dividend yield of the overall stock market was close to 14%. And most importantly, bonds protect against stock market volatility. Bonds have low volatility and they are slow and consistent. And finally, another thing to consider here, if you choose to repel everything I've shown you, if we had a depression, do you actually think that insurance companies won't be dropping like flies? And if and when there's a systemic failure of lots of insurance companies, do you actually think that your state's guarantee fund isn't going to get drained? In other words, the very reason that you put your money in an annuity is fear of a depression, but it's that depression that is the same depression that's going to crush those insurance company guarantees. But you might say, well, the federal government bailed out AIG last time. They might bail out all of the insurance companies in a depression. First of all, I doubt that if they did, it would be 100%. But okay, if they did, what would happen to the stock market? Well, the stock market would bounce back, making the open markets not as risky as you thought. So anyway, the next time some insurance salesman, broker, non-fiduciary certified financial planner, bank employee, or whoever tries to sell you an annuity based on hysteria about loss of principal, just hang up the phone or walk out the door and invest in bond and stock index funds, ETFs, through any deep discount brokerage firm.